Today we're going to look at a swing trade strategy using TQQQ, which is a leveraged ETF based on the NASDAQ 100. So it's 3x leverage, which means if the QQQ is up 1% in one day, TQQQ is going to be up 3%. The resulting strategy, which we'll go into today, was able to get on average 53% returns per year, had a max drawdown of only 12%, and had no years that it was in the red. So we'll start here on the backtest screen of wallstreet.io. We're going to start with a strategy based on heiken ashi candles. So this is the strategy that actually was in one of the videos, one of the promo videos that wallstreet.io had in their email when they were advertising the platform in the trial period. And basically it just enters a trade on the first bullish heiken ashi candle, and it's going to exit the trade on the first bearish heiken ashi candle. So these heiken ashi candles right here show you where it entered a trade and where it exited, right? So when we get this strategy and we take it over to this side of the screen, you can see how it was performing over the course of 10 years. So on average, 47.73% returns and max drawdown of negative 18%. And yeah, you can see how it did, right? So it was 44% correct, and 2.1 was the risk to reward. So not a bad strategy, but we had a couple years where we did have some negative years, and then several years where we just really underperformed just a buy and hold strategy. Another thing that's really nice about this platform that I mentioned in another video is the discovery feature. So this was how I kind of arrived at a better strategy than just the simple heiken ashi strategy here. So I went in to discover, and I looked for other strategies, saw the ones with the best returns, lowest drawdowns, etc., and then tried to piecemeal together something that I was comfortable with. So this is kind of how I did that. I started from this simple entry on the first bullish and exit on the first bearish. And this is kind of something I've been doing for a while. And intuitively, I thought that it worked. And it's been pretty successful just historically. But it was really nice to kind of put it into the data and see this sort of thing working. So like I said, I've been using heiken ashi for a while, and it's helpful, but nice to really kind of prove it with data. So one other thing that I wanted to add is an OR sell signal. So I can come in here and I can add basically another trigger for selling. And what I want to do is try and add something that's going to capture the behavior when we are in a more bearish situation. So typically when the trend is bearish, you do get these little bull relief rallies, but they are oftentimes short-lived. So what we want to do is we want to set this up so that we are exiting the trade on the third bullish candle when we're under the 21-day moving average. So for an example of that is like this trade right here. So we exit on this candle because we've had the third bullish candle. And that you can see it really improved the results. So I got 51.4% return, and my max drawdown is now only negative 14%. And I can just really quickly compare that to what I had before I made that change, and I can see the improvement. So let's keep that on. The other thing that I wanted to do is a lot of these times I saw a point that I probably would have considered overbought, and I probably would have sold just because it had been running for a long time. And so I started playing with some of that, and I found some strategies that basically were selling on when you had maybe the 9th or 10th instance of a bullish heiken ashi. So we're going to add another OR signal, and this one's just going to be to exit the trade on the 9th bullish candle. And so I got another 2% on average per year. And important to note, I'm looking at right now what we did over the past 10 years. So I can come in here and I can look at the past 5 years, and I'll see my results, and I can kind of change and see, what has worked in periods of higher volatility or lower volatility and that sort of thing. But since 10 years, we've got some volatility, we've got a lot of bull run as well. I think it gives us a nice little perspective of what has happened and how a strategy might perform moving forward. So when we look at the results of that change, we increased the return, but we also brought down the drawdown. So just to pull that out again, see the effect. So 14.72 to 12.25. And so we got the drawdown a good bit down, and that helps us out a lot. So the strategy becomes a little less risky. We also took out any of the negative years with that move. So if I come back up here and I put this in, I still had a negative year in 2011. I had a little bit more consistent returns, but each year you'll see they were a little lower than if I make this change. So definitely taking profits on that ninth bullish candle, no matter what's going on, is pretty effective at making sure you don't continue to stay in the trade and lose anything that you may have gained so far. And so the last thing that I wanted to add on here was a trailing stop. And the reason that I did this is because, this strategy is all based on historical data. All the performance and everything that I'm looking at is just based on historical data. So the power in that only goes so far because it's, not possible for it to predict the future. So I do want to have some sort of trailing stop in here just in case, the total unexpected were to happen. And, I was going to just at least limit my risk to the downside. So what I want to do is I want to put this stop loss at a place where I'm not going to hurt the returns too much, because you'll see that if I bring this down to say like 1%, because, let's say I was really risk averse, I'm actually hurting myself by doing something like that. So that's the last thing that I want to do. But I do want to have this extra safety factor in there, just in case the unexpected were to happen. So if I keep it at 5%, then I only hurt my annual return by about 1%. I keep all these other parameters the same. And so this is a good way for me to minimize that risk for any potential massive downside moves that may happen in the future. So that leaves us with a nice simple strategy that we can summarize by just using heiken ashi charts and one simple moving average. So the first thing you're going to want to do is set up your daily chart with the 21 days simple moving average and the heiken ashi candles. Heiken ashi candles are built into a lot of different trading platforms. I know that TradingView's got them. Then we just need to be aware of our entries and exits. So we're entering on any of the first green heiken ashis, we're selling on any of the first reds, or we're selling on the third green if we're under the 21-day moving average, or we're selling on the ninth green if we're over the 21-day moving average. And then another thing you can do just for some extra safety is you can put a trailing stop loss based on your risk tolerance. Just keep in mind that if you place that a little too close, you might get stopped out of more trades than you expect and end up hurting your results long term. So I hope you found this video to be helpful, and be sure to like and subscribe the channel, and check out some other videos that I have on the page that feature trading strategies for UPRO and SPXU, so you can use similar strategies for the S&P 500, both to the upside and the downside. Thanks for watching.